faithfully delivering value and exploring great books worldwide. Hello, this is Sally with Book Insights. Today, I'll be sharing insights from the book, The Warren Buffett Way. This book reveals how Warren Buffett, known as the Oracle of Omaha, approaches investing. When Buffett was 11, he bought his first stock. By age 25, he started his investment firm with just $105,000. By 2018, his wealth reached $84 billion, ranking him third richest globally. Building such massive wealth through investments, Buffett stands as the greatest ever. But, Buffett's status as the stock god isn't just about money. He crafted a whole investment philosophy and shared it, helping countless investors, from Peter Lynch to Philip Fisher to Bill Gates. Many authorities in investing and business have close ties to Buffett. They openly encourage adopting Buffett's methods. This book aims to reveal his strategies, helping everyday folks understand his success and start their journey to wealth. The author is Robert Hagstrom, a U.S. writer famous for his work on Buffett's philosophies. Time magazine praised it, saying, "No one has captured it better than Hagstrom." The first edition sold 1.2 million copies. Hagstrom details Buffett's journey, breaks down his approach, and makes it practical. I'll break down the Warren Buffett way into 3 sections. Part 1, what are Warren Buffett's 12 standards for picking stocks? Part 2, how does Warren Buffett construct his investment portfolio? Part 3, how to develop the key traits every investor needs. All right, let's start with the first question. What are Buffett's 12 criteria for choosing stocks? Overall, investing has 2 main approaches. The first focuses on price analysis, forecasting ups and downs from price swings to profit through short-term trading. The second approach values company fundamentals, concentrating on business growth and benefiting from long-term investments. You see, those in the first camp typically ignore the company's balance sheet. They believe stocks aren't closely tied to financials, and the fluctuating share price is a truer indicator of value. And Buffett, he's the representative figure of the second school, value investing. He said, if you don't want to hold a stock for 10 years, then don't even hold it for 10 minutes. His overall investment principle is to treat stocks as part of a business. Simply put, buying stocks means buying a company. Buffett's teacher, Benjamin Graham, known as the father of security investing, once said, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. Meaning, the stock market fluctuates daily, unpredictable in the short term, like a noisy voting scene. But when we extend the time scale, we see that a company's stock price is mainly determined by its value. For example, in China's A-share market, Leico's stock once soared sky high, but soon hit rock bottom. When the Baiju industry faced the plasticizer crisis, Mutai was affected. Its stock price plummeted. But over the following years, it kept rising and hit new highs. Since we're doing value investing, we need a comprehensive evaluation of a company's worth. The author distilled Buffett's 12 stock picking criteria and categorized them into 4 groups: corporate management, finance, market, and valuation. First, let's examine the corporate category, which includes 3 principles. First, whether the business is simple and understandable. Second, whether the business has a consistent and stable operating history. Third, whether the business has good long-term prospects. Simple and understandable means the company's business is easy to grasp without specialized knowledge. For example, 2 stocks Buffett bought, Coca-Cola and See's Candies, have very simple business models, profiting from selling unique products. Another example, looking back from 2018, over the past decade, Buffett rarely invested in tech companies. Now, many folks mock Buffett for being old-fashioned, but actually it's his conscious choice. He believes these companies' operations are too complex to assess, so he prefers a conservative approach. For instance, Amazon stock has soared year after year, but with numerous interconnected business segments, it's hard to value. The company maintains a consistent and stable history. This means investors should focus on the company's actual development track record. Look at whether its journey has been reliable, providing stable products and services while maintaining steady profits. This principle isn't hard to grasp, but in practice, investors often overlook it. How about the company's prospects? It's a question that requires time to ponder. In this regard, Buffett has discussed extensively. He divides companies into two types. One part is great companies with moats. The other part is ordinary companies that make up the majority of the market. He believes companies with moats have better prospects because these companies share common traits. They're needed or desired and irreplaceable. These traits allow them to maintain prices, occasionally even raise them, without worrying about losing market share. For example, in Buffett's view, Coca-Cola is such a company. People love drinking cola. Coca-Cola has a unique formula and brand effect, making it hard to replace. Buffett explained the term moat. He said, "What I like is a big castle with a wide moat around it, filled with piranhas and crocodiles." In other words, the fewer companies that can enter the moat's domain, the better the company's prospects. After evaluating the company itself, the second category of principles is about management. Whether the leadership is rational, candid, and can resist inertia. Many people, when investing, rarely consider management factors. But Buffett explicitly states that just looking at the company isn't reliable. Management is crucial. The companies he invests in must be managed by leadership he admires, trusts, and is competent. In the capital market, incompetent management often becomes a landmine. For example, Enron was once the world's largest energy company, ranked 7th in the Fortune 500. And one day, that management kept cooking the books and manipulating stock prices, eventually leading to bankruptcy. Many wonder, since individual investors can't easily access company management, how to make judgments. Buffett offers a great solution. Look at the company's annual reports from past years, especially carefully reading management's forecasts and plans for the future. And compare the day's results to see how much of the original plan was achieved. Compare what's different between the company's past strategies and today's. This way, you can see if management has good judgment and if they can lead the company in the right direction. So, after understanding management, we also need to look at the company's financial health. In this area, Buffett focuses on refining commonly used financial metrics, simplifying complex company finances into straightforward investment principles. And there are 4 standards. First, Buffett believes investors should prioritize return on equity over earnings per share. Earnings per share is simply the company's total annual profit divided by the number of outstanding shares. Often, investors just look at basic earnings per share figures, but Buffett argues that return on equity is what truly matters. This metric shows how much profit each dollar invested by shareholders generates, truly reflecting the value created. Many companies have good profits but require massive capital investments, so their return on equity remains low. Take some internet companies today. They may appear strong with high revenues and decent earnings per share, but this performance relies on continuous rounds of financing, meaning constant capital injections from major investors. Thus, even with good earnings per share, the actual return per investor isn't high. The second financial standard is calculating true owner earnings. Typically, investors judge operations by net profit. But Buffett believes we must subtract capital expenditures from net profit to get owner earnings, the more accurate measure. For instance, in many industries, A large portion of net profit goes toward new equipment to boost productivity. Long-term high capital expenditures can reduce investment returns. The third financial standard is seeking companies with high profit margins. This makes sense. Higher margins mean better returns for investors. Before the internet, the media industry exemplified this. In 1984, Buffett wrote that a dominant newspaper's economic value is exceptional, among the world's best. In the early 1980s, of America's 1,700 newspapers, about 1,600 had no direct competition, ensuring high margins, key to Buffett's Washington Post investment. The fourth financial standard is the $1 principle. Each dollar retained should create at least $1 in market value. If a company reinvests profits instead of paying dividends, it must generate more market value than the investment cost. For example, if a public company earns $1 billion this year and reinvests it instead of paying dividends, it must ensure this investment increases market value by over $1 billion to demonstrate sound financial management. But after understanding the finances, we need to evaluate a company's stock from market perspective. Specifically, there are two criteria. The first market criterion is determining the company's market value. Here we must distinguish between value and price. A company's value refers to its intrinsic worth from all assets, while price is what others are willing to pay currently. Value is inherent, price is externally assigned. In stock markets, prices constantly fluctuate due to varying investor emotions and perceptions. For instance, Mutai's stock price might differ by 5% between days, significant volatility, while its intrinsic value remains nearly unchanged. Therefore, before investing, assess its long-term value. How? Buffett's method. Take the company's recent annual cash flow and, based on profitability and business model, project next year's cash flow. That's the enterprise value. This is a relatively simple and idealized projection approach, like depositing money in a bank where interest rates predict next year's balance. Buffett believes future cash flow can be similarly estimated. The second market criterion, whether you can buy at a discount relative to intrinsic value. As mentioned, value and price aren't always aligned. Often, stocks become undervalued during temporary crises, causing price drops. Buying then is like investing in a company at a discount. Like when Facebook faced privacy issues, media attention caused market panic, not existential, and stock decline. Post-crisis, it rebounded quickly. This principle tells us when you find a good company, don't rush to buy immediately. Wait for a discounted price to maximize your returns. Now that we've covered Buffett's 12 stock selection criteria, next we'll explore part 2. How to build an investment portfolio. Few investors buy just one stock. It's too volatile and risky. Smart investors create diversified portfolios to balance returns and risks. Common portfolio strategies include active management and index investing. Active management is Wall Street's go-to. Fund managers constantly trade various stocks. These managers try predicting short-term performance to impress clients quarterly and keep their jobs. The index investing skips stock picking. It mirrors an index's composition instead. In the US, it's mainly the S&P 500. In China, there's the CSI 300 index. Buffett suggests a middle path. Index funds, less effort than active management, steadier than individual stocks. These funds move with the overall market trend. For example, a CSI 300 fund follows that index, lower volatility and risk than single stocks. Buffett's claim that index funds beat active management challenged Wall Street pros, sparking his famous bet. In 2007, Buffett threw down the gauntlet to hedge funds. He bet that from January 1st, 2808 to December 31st, 2017, the S&P 500 would outperform hedge funds. Hedge funds represent active management. A Wall Street manager accepted Buffett's challenge. He picked 5 hedge funds, expecting them to beat the S&P 500 over 10 years. In 2018, Buffett revealed the bet's outcome in his public letter. Over the decade, the S&P 500 gained 125.8% total, averaging 8.5% annual returns. The best fund among those 5 gained 87.7%, 6.5% annually, while the worst gained just 2.8%, 0.3% annually. Buffett won the bet. The proved index funds are the smart choice for most investors. However, some investors want higher returns than index funds offer. For them, Buffett proposes concentrated investing, picking few high-performing stocks, investing heavily, and enduring short-term volatility. Implementing this involves 4 simple calculation steps. Listen carefully. Step 1. Calculate the probability of outperforming the market. For any stock in your portfolio, ask one question. Long-term, will this stock beat the market? If not, just buy index funds. No need to overcomplicate. At Stanford, Buffett used Abbott Labs stock as an example. He said, if I have a 90% chance to gain $3 and 10% chance to lose $9, calculate 90% times $3 minus 10% times $9 equals $2.70 minus $0.90. That's a $1.80 expected gain, but we must consider time. If Abbott's stock was $27 per share, $1.80 divided by $27 equals 6.6% potential return. Over 1 year, 6.6% is below the S&P 500's average. Not worth investing. Buffett's return calculation method is highly practical and accurate. The second step in concentrated investing is waiting for the right timing. When your target stock's price falls below its intrinsic value, that's the buy signal. Many stocks require this waiting period. For example, Buffett loved drinking Coca-Cola since childhood and had been observing the company for years. Yet he didn't buy shares until 1988. Why? Coca-Cola is the world's largest beverage company, selling over 500 drink varieties across 200 plus countries. By Buffett's standards, simple business model, wide economic moat, historically stable profitability over long periods. But in the 1970s, Coca-Cola faced constant troubles, worker abuse scandals, environmental issues, plus management's low-margin diversification strategy. In 1980, new leadership took over, focusing solely on expanding beverage markets while cutting costs and streamlining operations. Their first year saw profit margins hit 13.7%. By 1988, when Buffett invested, margins reached a record 19%. During this period, return on equity soared from 20% to 30%. From operations to management to financials, Coca-Cola's transformation captured Buffett's full attention. In 1988 to 1989, Buffett valued Coca-Cola between $20.7 and $48.3 billion, yet its market cap was just $15 billion. So in 1988, Buffett massively invested in this underpriced company with strong profit potential. In just 10 years, his $1.023 billion Coca-Cola investment grew to $11.6 billion. Okay, now for step 3, adjusting your portfolio based on new information. After investing in select stocks, maintain vigilance. Monitor management decisions, financial changes, and emerging competitors. If conditions shift, update your original probability assessments accordingly. Investment portfolios also need to adapt to trends. When times are good, add to your position. When conditions worsen, you can appropriately reduce investment. Historically, many companies have had such turning points. For example, Tencent launched WeChat in 2011, which rapidly became a fundamental social tool for people. If you had chosen to add to your Tencent holdings back then, by now, it would have yielded dozens of times the return. Another scenario is discovering a new company at the right time and adding its stock to your portfolio. At this point, you should compare the new opportunity with your current portfolio. For instance, if your current portfolio has an annualized return around 20% and you discover a new stock, after thorough research and judgment, you expect its annualized return to exceed your portfolio's average, then you should appropriately adjust your portfolio. The fourth step is determining the investment amount. Here, Buffett reminds investors to pay close attention to 2 points. First, don't go all in, meaning in daily life, almost no investment is guaranteed 100% successful. Therefore, never bet your entire fortune on any investment. Second, use leverage cautiously. Simply put, leverage means borrowing money to invest. Both Graham and Buffett strongly oppose borrowing to invest in stocks, and they also oppose margin trading from exchanges. Because when stocks fall, the exchange requires you to add more margin. This is often the toughest time in the market and when you're most short on cash. If you can hold on a bit longer, you might see a bright outcome. But to repay the debt, you often have to sell at a loss, which for investors is not only unprofitable but also very risky. Having covered stock selection and portfolio building, finally let's look at how to become a rational, patient, long-term investor. Buffett believes successful investing doesn't require high IQ or business school education, but a rational temperament. Specifically, it means looking back at the past, summarizing the present, analyzing various possibilities, and ultimately making decisions. Buffett's partner, Charlie Munger, said, "In my Harvard law class, there were thousands of classmates. I knew all the top students, but none had a mind as super rational as Buffett's." However, maintaining rationality isn't easy because humans are naturally prone to many psychological biases. These biases easily lead us to make mistakes in investing. Therefore, to invest well, we must learn psychology to overcome these mental biases. When Buffett was young, he experienced the negative impact of such psychological biases firsthand. At age 11, Buffett and his sister Doris used their savings to buy 6 shares of Citi's Service preferred stock at $38 per share. Months later, the stock fell to $26.95, a 30% drop. Having done thorough research before investing, Buffett remained calm. However, his sister worried constantly about the loss and nagged him daily. When the stock rebounded to their purchase price, their investment was finally safe. Buffett sold for a small profit, then watched the stock soar unbelievably to $200. Buffett learned two crucial lessons. First, patience is invaluable. Second, while short-term stock fluctuations don't affect company value, they cause immense emotional distress. Cases like Buffett's sister abound in markets. Humans have 4 common biases to overcome for rational investing. The first bias is overconfidence. Psychologists surveyed people about their driving skills. The result? Most claim to be above average. In another case, 90% of doctors believed they could accurately diagnose pneumonia, yet the actual rate was only 50%. Overconfidence causes errors. It's why traffic and medical accidents happen frequently. In investing, it's similar. Investors overestimate their knowledge while believing only confirming information. Meanwhile, they deliberately ignore contradictory evidence. Moreover, they evaluate only easily accessible data, never seeking unknown knowledge. Investors often feel superior, believing they have better information to outsmart others. Buffett says, everyone has a circle of competence. Don't pretend to know everything. By deeply studying select industries and companies long-term, you might uncover great stocks. The second psychological bias is overreaction bias. Scientists' research shows people tend to overreact to bad news but underreact to good news. Thus, when short-term financial performance is poor, People make rash overreactions without careful consideration. Consequently, stock prices inevitably get affected. Richard Thaler, a key figure in behavioral finance, primarily studies investors' irrational behavior. Taylor believes most investors would achieve higher returns if they didn't check monthly investment gains. To prove this, Thaler conducted a simple analysis. He ranked all NYC stocks by 5-year performance, selecting the top 35 and bottom 35 to form a 70-stock portfolio. Tracking it for 5 years, he found the worst portfolio outperformed the best one 40% of the time, meaning even top performers frequently fluctuate and face setbacks. If you see sharp declines and can't control overreaction, you'll miss huge return opportunities. The third psychological bias is loss aversion. Psychologists found the pain of losing equals 2 to 2.5 times the joy of gaining the same amount. Simply put, losing $100 hurts twice as much as finding $100 unexpectedly. Applied to stocks, investors feel intense pain during losses. When stocks plummet during crises, people often hold rather than sell. Selling locks and psychological pain. Vague hopes for recovery often lead to greater losses. The fourth psychological bias is herd mentality. Many blindly follow others' stock picks or rumors when investing. This inevitably causes losses. Constantly remind yourself to overcome these 4 biases to become rational. Beyond rationality, investors must cultivate patience. Per Nobel laureate Kahneman, human thinking has fast and slow systems. Investing patience requires ditching fast thinking for slow thinking habits. Fast thinking refers to a simple, direct, quick thinking process that doesn't take much time or require deep knowledge. For example, when we calculate a company's price to earnings ratio, we're using fast thinking. Slow thinking, on the other hand, involves repeatedly examining facts and conducting thorough research to draw conclusions. Generally, slow thinking takes a longer time, like days, weeks, or even several years. When an investor practices slow thinking, they settle down to gather more information. This includes competitive advantages, management's ability to rationally allocate assets, the company's true market value, and so on, or even conducting field research to understand consumer and competitor perspectives. To achieve the best state of slow thinking, you must spend time refining ideas, even through meditation. Warren Buffett is a classic example of slow thinking. The 12 stock selection criteria mentioned earlier require massive time and effort to figure out. Since the 1980s, Buffett's company has disclosed investment projects to shareholders through annual reports. Warren Buffett also uses cases and stories in these reports to explain what investors should watch out for. These methods have helped countless investors, many achieving financial freedom through them. Buffett himself is now 88 years old and still active in his role. He works in investments, generating profits for shareholders every year. Billions. Well, that wraps up our interpretation of the Warren Buffett way. The listening notes are below the audio. See you tomorrow.